Very good. Well, thank you all for joining us for our annual State of the Markets event. I again want to say thank you for joining us, and my team is also on the conference call tonight. So Larry Fiorini is here, Caroline Wozleski, Krista Hunsaker, Steph Serafin, Joe Lestraco, Matt Kitchie. The whole team is here. So again, thank you for joining us tonight. I'd like to introduce our keynote speaker here, Nicholas Cavallaro. He's joining us from New Jersey currently, but he is part of City National Rockdale, who is a subsidiary of RBC. And we have partnered with Nick and his team for a number of years now to help with portfolio management for all of our clients, and looking forward to getting his perspective on the current state of affairs of the market, what we can expect kind of moving forward for the rest of the year, some projections from his team. If you've ever joined us before for our State of the Markets event, there are a number of economic indicators that we would always present to our clients, and they were actually put together by City National Rockdale. So we really felt compelled to bring the team on here and let them speak for themselves about kind of the economy, the stock market, and what we can expect for the latter part here of 2024. So Nick is joining us, as I mentioned before, from New Jersey. Nick is a Cornell grad, where he received his undergrad, and then he received his master's from Columbia. Also was an attendee of the Yale School of Management and Syracuse University for a short period of time as well. So I want to say thank you to Nick for joining us, and I will turn the kind of reins over to Nick for the presentation this evening. And if you do have any questions, kindly hold them till the end, or raise your hand, and I'll be able to monitor the questions. If you want to type it in the chat feature, which will be at the upper left-hand corner of your screen, I'll be able to monitor that, and then we can make a list of questions for the end. So without further ado, Nicholas Cavallaro.
Okay. All right, Dean, thanks so much, and thanks everybody for attending this evening. Hope we can have a good presentation. When we were putting this together, I told Dean, we'll have about 30 slides in the slide deck, but there's really only about 4 or 5 that I think are really the most important that probably everybody would be interested in. So we'll start with those. And then, as Dean said, if something comes up that kind of piques your interest and we want to spend a little bit more time, we'll gather some of those questions toward the end. I want to make sure that it's a good, useful, time period for everybody, and hopefully we all get something out of it. So I'll pull up on my screen the presentation. And Dean, if you would just let me know when you can actually see this here.
We look great, so thank you very much.
Okay, you've got it.
We do.
Okay, great. So we'll start as far as an agenda a little bit with respect to the economy and our economic outlook, and then we'll dive into a little bit more some of the individual asset classes, stocks, bonds, and kind of wherever that may lead as we go through. I'd like to start here on page 4. And I know it's a little bit of numbers, but I think it helps to lay the groundwork for how we see the economy over the rest of the year. And again, our economic views help to shape what we may do in a portfolio or what we may not do, right? At the end of the day, right, if there's an opportunity in the markets, we want to make sure that we capture that. If there's a risk in the markets or an economic risk, we want to try to avoid that, right? So it's always a little bit of offense and defense. What I will point to in the upper right-hand corner is that when we think about economic growth, you generally think about GDP or gross domestic product. We're penciling in about a 1% gain in real GDP growth this year, and it's really not that much. Usually you like to see 2, 2.5, 3%. We think it's going to be a little bit of a boring or a sluggish or a challenging type of a year. I heard somebody use the word the other day, uninspiring. I heard somebody use the word slow session. It's just not too hot, not too cold. We don't think there will be anything surprising on the upside or the downside, right? So kind of a sideways type of an economy. That said, I do like to look at the second line, corporate profit growth. This is how much companies make, right? Their bottom line, their profits from one year to the next. And we actually think that this comes in fairly healthy. So 6 to 12%. So if we pick a number in the middle, 10%, if companies are growing their profits each year by 10%, right, the companies themselves are becoming more valuable. So if a company is becoming more valuable, the stock price of the company also becomes more valuable. Said another way, right, with everything that's going on in the marketplace, we think the path of least resistance for stocks is higher this year, right? So even if the economy's not doing anything amazing, if companies are still doing well, that can be a nice tailwind for stocks. And on the next page, I'll get into some of the risks that we also think are out there, right? It's not all, skipping through the pastures here, but we do think that tailwind is quite nice for owning equities in this type of environment. Some folks like to ask about inflation. Certainly we had inflation 3 years in a row. It was pretty high. We think inflation probably comes in around 3% this year. And for folks who really like to look at the bond market, we think the federal funds rate will come down, call it 2 to 3 cuts this year. At one point, the market was being quite aggressive with their take on interest rates, but we think it'll be a little bit more moderated as far as what's going on in the interest rate world. I'll take this and also look at page 5. This is the same data, and these are these speedometers that Dean was referring to. It's the same data, except instead of numerical form, it's in green. You read it like a traffic light, green, yellow, and red, right? And you don't see any greens on the page here. It's mostly yellow. And again, if it's mostly yellow, we kind of see that as a neutral type of an economic scenario. We have a couple of reds, and if we looked at this page back in the fall, September, October, November, I think we had maybe 6 or 7 reds on the page. So we're getting a little bit better. I wish my marketing team would give me at least a green on there so I could kind of point to one and say, oh, we're getting even better. But the reality is it's just a little bit of patience here as far as where we see the economy going and where we are taking our chances. In this environment, let's take what we have here on the page, a mostly sideways yellow types of speed dials, and think about how that applies to different markets. Well, at City National, we like U.S. securities significantly better than international securities. And if we think about that, 2 of the red dials on here, the international economic outlook is red. And this might flutter between red and yellow, but it's a little bit more left than anything else. And then also geopolitical risks, right? There are risks to emerging markets and developed markets that we don't think you get rewarded for in this environment. So even just recently, the United Kingdom just went into a recession. Japan has been in a recession. We have geopolitical risks in the Red Sea, right? If you are a business in Germany and your container ship now has to go all the way around Africa, it'll be, call it 2 weeks late and 20% more expensive. We don't think that you get rewarded for those extra risks. And then obviously there's certainly the geopolitical ones, right? We've got conflict in the Middle East. We've had an ongoing conflict in Ukraine, and you have some, chatter with respect to China and Taiwan. And oh, by the way, the Chinese markets are certainly lagging, that would be happening in the US. So we like the US markets significantly better than international. And those folks who are clients with us certainly see that almost all of the equities are US companies, right? Now, we might invest in certain US companies that sell their products and services all over the world, right? Apple, as an example, right? Apple sells all over the world, right? I'm not going to not own Apple because it sells to Europe, right? It's certainly a good market for them, but we don't have international as a dedicated asset class. The other aspect within the US is we really like quality businesses, right? So I mentioned Apple. We like companies like Microsoft or Home Depot or McDonald's or MasterCard. All of those businesses are growing their profits, their bottom line 10, 20, 30% every year. I like owning companies that grow. I like owning companies that not only do they grow, they reinvest into their own business, right? So I think Apple's now with the iPhone 17. I hope they come out with the 18, 19, and 20, And I hope they come out with a watch for each wrist and the Beats in the App Store. So I want those companies to continue to grow their profits and continue to come out with new goods and services and continue to find new markets where they're able to sell those. So we like the quality businesses. And then lastly, we just try to get them at either a good price or a fair price. And that helps with some of the turbulence that the markets can give us on a day-to-day, week-to-week, month-to-month basis. So that's kind of a quick overview as far as what we think from an economics perspective and how we like our positioning on the stocks. I'd like to go to a market slide on slide 12 here, because this is a little bit interesting. And this is a little bit of a change. If we look at the S&P 500, right, those are the 500 biggest companies in the US, over the past year, year and a half, it's become very concentrated. And what I mean by that is, if we look at the top 7 companies, you may have heard these as the Magnificent Seven, or we call them the Tech Titans. They've become an increasing bigger piece of the entire market. And you know some of these companies, right? Apple, Microsoft, Amazon, NVIDIA, Google, Meta, and Tesla. 7 companies now make up for almost 30% of the entire market. So we have this situation where a select few companies can actually move the entire market up or down on a given day, right? We like many of these companies. We might not own them to the same size that the market has, but we're just aware because sometimes you might have some buyers that are forcing the market higher, or if the pendulum swings the other way, selling out of the market kind of the other way. So being smart about what companies are solid companies, good businesses, again, making sure that we get them at a good price. And then lastly, making sure the sizing of the positions are also appropriate, right? As an example, just look at the first 2, Apple and Microsoft is almost 13, 14% of the market. I don't think we have any client who has 13 or 14% of his or her portfolio just in 2 stocks. To us, that seems a little bit too concentrated, a little bit too risky. We'd rather be more diversified across many other names, right? We have technology, we have healthcare, we have industrials, we have consumer names, right? So I want to make sure that diversification is appropriate as well as we go through the year. What's also interesting here on the next slide is the past 2 years have really been a tale of 2 different stories, right? And I know the chart on top might be a little bit busy, but I really like this grid at the bottom. And across, you can see 2022 and 2023, the S&P 500 was down almost 20% in 2022, and then up 26% last year in 2023. So if you bought the market on January 1st and of 2022 and held it for 2 years, you only made 3%, but you had such a wild ride down and then back up, right? So part of the reason we want to make sure that we're diversified is if we can minimize some of those downturns in the marketplace and still participate on the upside, that would be one of the goals that we want to make sure that we can try to manage for folks, as we navigate some of these choppier waters. The other thing that's been interesting is the bond market, this second column to the right here, second from the right. The bond market was down quite a bit in 2022. And it's not because companies went out of business, it's because interest rates went higher, right? So as interest rates go up, the price of bonds go down. Again, I think that's just an interest rate move. We saw a nice bounce back in 2023. We're expecting bonds to have a positive year this year. But if you were a bond investor in 2022, you're still underwater there, right? So that's a tough road as far as folks who are just looking to get some income out of the portfolio. Again, I think we have opportunity to own individual bonds. I think that's helpful. But just to kind of show that it's been a volatile 2 years, again, risk management is really key here as far as kind of the past 2 years and as we go through 2024.
And just to add to that slide, Nick, I think that's a very, very enlightening slide, and just wanted to point out the impact of sequence of returns and what that means for a portfolio. So if you look there, it's astonishing to think that, last year in 2023, the S&P was up 26%. And had you bought in 2022, you would have experienced that initial loss of 18%, but then subsequently a rebound of 26 and only been up 3% over the course of that 2-year period. I mean, that is a reason that you should be diversified. That is
Yeah.
why we diversify away from just being in the S&P 500. A lot of clients are saying, why not just buy the indices? And this is a true example as to why you don't just buy the indices, because if you're pulling income out from the portfolio during that time period, it can be very detrimental. So you need to make sure that you focus on the right companies um, that are paying strong dividends, that, as Nick mentioned earlier, are fundamentally sound, strong companies to help mitigate that sequence of return risk. Um, and consequently, as well, the bonds market went down tremendously. So that's why you don't want to just flip the switch from being invested in the equity markets and then all of a sudden you're in retirement looking for income, and then switch to one type of investment moving forward into the bond market. So uh, all that I just wanted to expand on that a little bit. So
Yeah, that's
I'll let you take.
it's the sequence of returns, Dean, I think is really important. And as you were saying that, I was looking at the Nasdaq in the middle. It was even more pronounced, right?
Sure.
Sometimes people see on the commercials on TV, right? Buy the QQQ, right? That's really what the Nasdaq is, and that can be a good product, or that can fit into some portfolios, but it was a wild ride, right? A -33 and then a +45, and you're still down. Right. So these are the things that we think about, right? There's a time and a place to add risk, right? Again, going back to our speedometers, if I were to kind of go back to the slide at the beginning, we're not there yet. If we start to see some greens pop up on the page, we get a little bit more certainty as far as where the economy is going. That would be a time to lean into risk a little bit more. Maybe a little bit more on equities, maybe some more growth-oriented businesses, maybe even something like small cap or mid cap for portfolios where you get a little bit more bang for the buck. But we're not going to force a trade. Right? We're just not going to do that. That doesn't make sense. Nobody wants to gamble their retirement money to try to make a couple of extra dollars. That to me doesn't make sense.
I think, Nick, this would be a time maybe to expand on the interest rate environment. And, a lot of clients have been asking Larry and myself and Matt as well, and Joe and the whole team, are there anything, or is there anything other than interest rates that are going to be driving the market moving forward? What are you forecasting, and what do you think is going to help drive the markets in either direction
Yep.
moving forward, other than the interest rate environment?
The interest rates is certainly a big driver in the short run. We are expecting U.S. stocks to be high single digits this year, and we're kind of already out of the gate, a nice little positive to start the year. But earnings certainly going to be, if earnings kind of going back to this initial 6 to 12% profit growth, that is a driver over a time period when you look at it from year to year. The other would be, if I were to pick a thematic answer, we've had a huge increase in AI, right? So a lot of the artificial intelligence names have had a huge boom to their valuations because the potential for growth and profitability is so much greater. It's a new technology. We're not still 100% how it's going to evolve and how it's actually going to play out. But when we think of companies that are tied to that space, and we like a handful of them, you think of a company like Adobe or NVIDIA or Microsoft, all of those companies are already good businesses. And then you also throw this newer technology and AI or generative AI into those businesses, and you get a new creative product, or you get a new creative solution that can then be used in some other new manner. Right. So I think that AI tailwind has certainly been helpful, especially for those three stocks. We would be less sanguine and less optimistic on a company that maybe only had one AI product. I'd rather have a business that's established and then take the AI and kind of roll that into it. Microsoft being a prime example there. So I would say interest rates, artificial intelligence, earnings, those are probably the three big ones, from a markets driver perspective on the upside, right? On the downside, we only talked about a couple of risks. It's probably worth kind of going back. Geopolitical risks certainly could come out there. We have an election year coming up. We might have a circus in DC for the next 8 or 9 months. and it could be something that a candidate says or doesn't say, or the media picks up something and interprets it differently. Those types of things can move the market on a day or a week or a month. Longer term, usually markets or elections are I would say less impactful unless it's where there's money or where there's actually the economy is going, or where actually companies are actually doing their actual business. So there are some risks out there, and then obviously if inflation picks up, that could be another risk if we get a surprise with interest rates. And then lastly, there could be something that isn't even on our bingo card, right? If we were having this conversation a year ago, right, the big headlines at that time was Silicon Valley Bank, First Republic Bank, right, Signature Bank. We had a mini banking crisis last March, right? Thankfully we didn't own any of those banks in client portfolios, but that was a real scare. The market did sell off on those types of events. Obviously, we've been able to recover since then, but that's the reason why we want to make sure that we can monitor those risks, because something could pop up out of the blue, and we want to make sure that we're looking at both kind of what the risk is as well as the price, and to decide whether that's an environment where we think the economy and company is going to be okay and we'll buy, or if there's a real risk like COVID and the pandemic, that's when we're actually de-risking. So I want to look at both what's actually happening and not just the price of stocks.
Very good. Thank you.
Yep. Dean, one thing we haven't talked about that much has been on interest rates and bonds, right? Everybody likes to talk about stocks, right? Nobody goes to a cocktail party and says, wow, I've got the best bond portfolio. But it can be an important part for folks who are really looking for stability or cash flow, especially if somebody's in retirement, to make sure that the bond piece of the portfolio is quite solid. This is a slide we typically haven't shown because interest rates have been so low. But if we look at this number to the right, where it says U.S., the 1 to 5 year investment grade, right? That index is now at about 5%. It's actually a little bit higher than that today, about 5.05%. That's a good return for investment grade bonds. So think about owning individual bonds of companies like Amazon or Nike or Goldman Sachs or Citigroup, right? We like to own the individual bonds where we can, right? And even if the price fluctuates, as long as the company stays in business and repays its debt, right, we're comfortable owning that bond, right? So I think about Amazon as an example, right? If we own a bond for Amazon, the only way we don't get paid is if that company goes out of business, right? If Amazon goes out of business, we've got a problem with online shopping, right? If Nike goes out of business, we've got a problem with footwear. So I think of these as a low risk, medium reward type of pieces to the portfolio, right? And the fact that we can get 5% here in investment grade, I'll take that. I think that's a good piece to own for clients. So we certainly like investment grade bonds. We also like parts of the high yield market as well, right? So we're getting about 7.5% in high yield. So some clients, I had a client review with somebody yesterday, and we actually had a 12% return in high yield last year. Part of it was the yield, and part of it was a little bit of a turnaround from the year before. We're not going to get 12% in high yield every year for clients, but can we pencil in a 6, 7, 8? I think that's somewhat reasonable, barring any negative type of credit event or recession or banks going out of business. We think that there's some good yields to be had there. So a very good environment for bond investors, and we just really haven't been able to say that in the past 15 or 18 years, right? We've had low interest rates. Interest rates have been on the floor. So now we're actually getting some type of return there. So again, low risk, medium reward for investment grade. High yield, I would say low to medium risk with a medium plus reward. That's kind of how I would view that trade-off there.
So to just expand on that, Nick, this is more of a question that I have. For a number of individuals that might be cycling out of treasuries that are coming due, would you be leaning more towards the corporate side, the high yield side, or looking at potentially renewing another treasury for a 6-month period, maybe a 12-month period, 18 months? Where do you think the sweet spot is for an individual that's cycling out of treasuries, more as a safety net, more so than anything, so safe money?
Yep.
Where would you recommend that they go?
Yeah, Yeah, I think treasuries over the past year plus have been and still can be a good buy. I would encourage folks to start to think about more investment grade because the yield pickup is a little bit more. And what I mean by that is anybody can go to get a 3-month treasury or go to your local bank and get a CD, and you might get a rate of maybe 5.25, right? And that's a good rate, and you can get that. The issue is 3 months from now or 6 months from now, interest rates are, in our view and the market's view, very likely to fall, right? So if you buy a 6-month bond or a 9-month bond and you get 5.25, 9 months from now, if you go to reinvest that money, you might not get 5.25%. You might get 4.25, right? So there's that risk of reinvesting. It's actually called reinvestment risk. The way we think about it is, I would rather own, again, bonds that are corporate bonds like an Amazon or a Nike or whatever it might be, strong, solid companies. But we would buy them in the 3, 4, 5-year part of the curve. So bonds that mature 3 years out, 4 years out, 5 years out. And we're willing to give up, 1/4 of a point of return up front if we're effectively able to lock in a 5% return over the next 4 years. Right. So again, I'd be willing to give up a little bit up front, knowing that I can lock in that 5% return for the next 3, 4, 5 years. I would do that for safe money. I don't know that I would take safe money and then back up the truck in high yield. That to me changes the risk profile. But we feel very good about investment grade bonds. And if anybody's in a very high tax bracket, potentially municipal bonds, but that's on a case by case basis. The investment grade corporate bond market looks very, very good to us.
Thank you for expanding on that. Appreciate it.
So to kind of wrap it all together, and maybe we can kind of start to take some questions, if any are floating out there. We think the economy is pretty much a sideways economy. We think the big blue chip champions in the U.S., high quality companies continue to do well. We like U.S. stocks. We like the higher quality companies. We haven't talked about dividend stocks, but if somebody really needs income from dividends, that can be part of the portfolio as well. Right? I think about a company like Coca-Cola. They've raised their dividend for over 60 years and also raised their dividend again this morning or earlier today. And then, we've talked about risk and positioning. And then for some folks who have, need a little bit more attention to taxes, as far as managing taxes, as far as capital gains or distributions from mutual funds, that's certainly something that we can look at on a case-by-case basis. And then obviously cash flow planning. I think that's something that City National Rockdale does fairly well. So happy to kind of conclude some of the prepared remarks. I don't know if Dean or Larry have any questions, or if any have kind of trickled through, or Dean, how you want to kind of go from here.
Well, what I'm going to do now is I'll give anyone the opportunity to unmute themselves and ask a question freely to the audience. But prior to that, I personally have one question for you, Nick. You mentioned the election earlier, and obviously that's it's in the news every day. And then you also mentioned policy changes that could be present with a change of the guard potentially, or whatever it may be. One thing in particular would be the tax cuts that are going to sunset eventually in 2026. How do you see any type of tax cut impacting the market moving forward? Whether or not they renew the tax cuts, do they change it? I know there's a lot of legislation out there that's kind of still a little murky, so I'm not trying to put you too much on the spot here with information that we don't know what will happen. But if you do see that raise in taxes, what's that going to do for the market?
Yeah, that's a tough one, because it's still almost 2 years out, and we don't really know who the players are going to be. But if we have policy that becomes heavier from a tax perspective, that would be potentially a headwind. Headwind on, it depends kind of how it evolves, but it could be a headwind on the consumer. It could be a headwind on stocks. We'll have to kind of see how that plays out to see where more of those risks bubble up. But it wouldn't be a positive as far as corporate profits or stocks perspective. You mentioned policy. I think that's actually where the key really lies. So I know it's a presidential election cycle coming up, but we also are very in tune with how Congress gets shaped because legislation has to pass through Congress, and that's where the money goes. So kind of follow the money, and kind of the evidence kind of leads you to your conclusion there. We think about and kind of watch where that might end up. So if we think about something like the CHIPS Act, right? You had money come into that specific industry. We had the infrastructure bill. You have the green energy policy. So now when we're analyzing individual companies or individual sectors, if we find a good business and then they also get government funding, that's another reason for us to own the company or potentially add to that position or maybe own it longer than we may have originally intended. So those can certainly be tailwinds. I don't want to necessarily chase something that might just be government funded, but not necessarily the greatest of businesses. That to us isn't the most prudent way to be investing on clients' behalves. We can speculate, right? If somebody wants to speculate in one or two names, we're happy to do that. But as far as a course of action for somebody, that's really not what we think is appropriate for clients.
Very good. So with that being said, I do have one other question, but I will save my question for the later because it's very possible that one of our clients that's joining us this evening might have the same. So please do not be shy. The chat features up there. If you understand how to unmute yourself, please do and speak freely if you want. Or I also have my email open, so if you would like to email in your question, I'm happy to share that with the group here. So.
Did we do that good of a job?
Well, I would say that we may have done a very good job, and undoubtedly you have done a good job. So I appreciate your time here. Earlier you mentioned AI. Okay. From a growth standpoint, are you seeing or projecting that the majority of the AI growth is going to be from mergers and acquisitions, or do you believe that some of these smaller companies that are driving or getting into AI are going to start to take off? Where do you see the growth in the AI field?
It's such a nascent industry. Some of it we kind of know where it's coming from. I think about the demand for some of the hardware, right? NVIDIA is a perfect example, right? You have to have the semiconductors to power that. All right. You think about, right, the gold rush of the 1800s, right? Some people struck gold, but the people who really made a ton of money were the ones who sold the picks and shovels, right? NVIDIA is kind of one of those picks and shovels types of companies. I really like, and we really like Microsoft as far as taking that technology and kind of having that flow through all of the businesses that they already have and having a new technology actually come about, right? A new use or a new service that we might not know what that new technology might be 6 months or 12 months from now. So I think there's a little bit of an unknown there. We might get some merger and acquisition activity. I don't want to kind of hitch my wagon to that one as far as putting all of our funds there. So I'd rather go to some of the more established players and kind of let that technology play out and see where it goes. Right, because there are some, right, if you think back to all of the fads over the past 5 years, right, marijuana was certainly a big fad at one point. Bitcoin kind of had its heyday, sold off, and now it's kind of back in the news. Right, we'll have to see kind of where this comes about, but I'd rather take a newer technology in an established company and let that rip than to try to chase a flyer on an M&A. It's just something that I think is harder to do, and there's a little bit more downside than upside. Even if it's less exciting, right?
Yeah, understood very much. Anyone else have any specific questions? It's a very unique experience to have a portfolio manager like Nick on the call here. So as you know, I like to pick his brain. And so, a very unique type of conference call tonight where you can pick the brain of a portfolio manager. So please feel free to ask any questions you might have. And if not, you can follow up with Larry, myself, Matt, Joe, the rest of the team tomorrow with any specific questions, and we can certainly address them on a more personal basis. So,
Hey, Dean, can you hear me?
yes.
It's Chuck
Yep.
Reed.
Can you-
How are you?
Very good.
Nicholas, question for you. I've been hearing about this Magnificent Seven for a long time now. Been what, 2 years, maybe even longer? What do you see happening with that? Do you see the S&P, getting more diverse, or is this the new norm, and we should just get used to Magnificent Seven, which may switch by one or company or so, continuing to drive the market?
Nick, I'll take that to start, and then you can expand on it. Okay. So Chuck, when you think about the Magnificent Seven, you have to think of what cap weighted means. Okay. So there are cap weighted indices and there are not cap weighted indices. So if we look at a portfolio manager, and Nick alluded to this earlier, they're not going to be exposed to 7% of their holdings being in a Apple, because they're going to diversify away from that. Same thing with the Microsoft. They're going to have 6% in Microsoft and so on and so forth. They're going to peel it back so that it kind of protects more on the downside. As far as the indices is concerned, it's hard to bet against that sector right now. It's really hard to bet against that sector as you continue to see advancements in technology. I mean, heck, I was just talking, actually, my daughter this morning. She sent me a video she was watching, and it was talking about phones and how we, as young adults, had to share a phone with our parents, and how if we wanted privacy, we had to go downstairs and go to the bedroom and unhook the cord from the wall so that we could have a private conversation. Or if we were staying up past our bedtime, that we had to make sure, excuse me, all the phones were turned off so the ringer didn't wake our parents. So think about that technology, and in just a short period of time where we are today, that this cell phone here has more technology than the first spaceship that went to outer space. So tech is undoubtedly going to continue to grow. Are there other industries that may keep pace with that? Sure. Is energy a good industry? Is healthcare certainly a growing industry as there's technology advancements there? But if there is a tech company that's also going to be in healthcare, you're going to see the profits from a technology company grow because of their advancements in healthcare. So I would say that there's still going to be several stocks that are driving S&P 500 performance moving forward for at least for the foreseeable future. But Nick, if you can expand on that.
Yeah, I thought that was a really great answer. I'll give you one more example, and then Chuck, thanks for the question. I'll also answer it directly too. If we were to think over the next 5 years, which company is likely to do better, Microsoft or a utility company? It's probably Microsoft, right? Because Microsoft can continue to grow new services, new products. They've got AI. They can reinvest in the business. They can go all over the world with where they want to invest or try to find new customers or new companies. But your utility company, they don't really have a growth strategy. I've never gotten a phone call from my utility company that said, Nick, we need you to use more power this month. Right? It just doesn't happen, right? So the growth for some industries and some companies just isn't there, right? That's why utilities tend to pay higher dividends, because they can't really do anything with the money. Whereas growth companies like Microsoft and the Magnificent Seven, still have a pretty good runway as far as growth is concerned. Now, as far as where the markets evolve going forward, it's hard to see that reversing. Right, you'd have to have something that would really be a catalyst to make it reverse the other way, and part of it is you have a lot of what I'll call forced buyers into the market, right? So anybody who is just passively investing in their 401k or whatever it might be And if you just buy an S&P, Vanguard or a mutual fund or whatever it might be, right? For every $100 that gets invested, you're buying $7 worth of Apple and $7 worth of Microsoft and another $6 worth of Amazon, right? So you have buyers every week who are buying those 7 companies in higher dollar amounts, more than the rest of the market, irrespective of what happens to the price of those stocks. And so I think some of the swings that we can see on the upside and the downside is likely to be more volatile than maybe what we've seen in previous years, right? We looked at the NASDAQ and we saw a minus 45 or a minus 33 and a plus 45. That's because you have forced buyers on the upside and potentially forced sellers on the downside. So again, we want to own some of the good companies, own them in the correct amount, right? We're looking at price as we do this too. But I don't want to get caught up in some of the swings to the up and the down just because the market is structured a different way. But agreeing with Dean's comment, tough to bet against it. We think the way we have it positioned is appropriate. But Chuck, to answer your question, I do think that is more of the new normal as far as that concentration at the top.
And is that good or bad? When I hear or read,
I was just gonna,
analysts say, of course, the market's driven by 7 companies. What I think I've heard is that's not necessarily good for you as an investor, because from a diversification perspective, you can do diversification all you want, doesn't matter. 7 companies drive the number, float the boat, float the lake. So how do I think about that answer? I don't disagree with the response, but is that good or bad?
I'll take that first part, Nick, and then you can expand from there. So
yeah, I think we're going to have the same answer, Dean.
Yeah. So the answer to that, Chuck, is that it depends on what stage of your planning you are in. And Nick alluded to a company that's a cash cow. Okay. Whether it's a utility, whether it's telecom, whatever it might be. If you think of those companies that are generating boatloads of cash, whatever company that is, if it's a cell phone provider, a lot of individuals will take a look at their budget, and cell phones are arguably now a utility. It's a requirement. In order for you to access your bank account, you need to have a cell phone because you need your multi-authentication factor. If you want to log into anything, you need some way to get and verify your identity. So those companies that are going to continue to be cash cows are very good at, as Nick alluded to, paying a strong dividend. So if you're looking to slowly grow your portfolio and you're in retirement phase and you also want to start taking distributions, those dividends are going to be very impactful. So the companies that are those cash cows are important for individuals that are looking to still slowly grow their net worth. They've kind of made it to the finish line, or we'll say made it to the peak of Mount Everest, but now we're descending and we're heading down the distribution phase of retirement planning. And ultimately, there are a lot of individuals that have gotten to the top of Mount Everest, but they have not descended properly and did not make it back the entire trip. So by putting those type of companies that are the cash cows into the portfolio at the right stage in your planning process, it's a very important thing. So that's kind of my take as to, is it important to continue to own all of those? Yes, absolutely. Just in the right kind of pieces.
Thank you. Appreciate that.
I can't believe that Nick's not expanding on that. I think I did a pretty good job there.
I thought that was a really good answer, and I don't think it's necessarily good or bad. It does depend on what each individual person or each individual portfolio is looking to achieve. That's what matters really at the end of the day.
Okay. Well, with all that being said, if there are no further questions, speak now or forever hold your peace. I appreciate you all joining us for our annual event here. Nick, I appreciate your time this evening as well. Thank you for all of the insight and your partnership. And thank you to each and every one of you joining us tonight for your trust in our firm. here at Flagship, and have a great evening and enjoy the rest of your night. Thanks, guys.
All right, thanks, Dane. Bye, everybody.